have trade war drama, economic data, and look at that reversal today in markets. You were down at one point around 0.5%. Looks like you're forming a bit of a double bottom here. The S&P at the time of recording this video is up 1.25% today. Here's what you need to know and what could be coming next for markets. Is this the bounce that a lot of us have been waiting for, or is this another strategic unwind, as we have seen in recent days? Now, if I told you with any degree of confidence that I knew what was coming next, that would be a lie. But I can tell you what to watch out for, when events will take place, and how we're positioning and how sentiment looks for markets, which can give you a pretty good indication of what could be coming next. And I do want to be very clear before we get into the economic data that came out today that was a big disappointment. Until we have clarity on the economy, until we know that the economy is doing just fine, the markets are likely not going to steamroll back to new all-time highs, especially with the ongoing trade war. This is going to take some time. Do not be super fast in going all in on stocks again. Now, do what you guys want to do, but we have reciprocal tariffs coming in a month, okay? That will be coming. So the trade war is not over, and there is very little clarity on what reciprocal tariffs could look like, how they can impact the economy, and as I will share with you here in this video, I mean, people are warning, like the Commerce Secretary is warning about inflation from tariffs. The data is kind of aligning with more inflation from tariffs at a time in which the economy is weakening. That's not a good setup for stocks because inflation will prevent the Fed from easing, and then you're kind of just at the mercy of what does the economy do. Long story short, I do think markets can bounce here. I think you've actually bounced like a bit. You could get back up to this 100-day moving average at $592 per share if we do get some positive headlines. But unfortunately, even from the low of yesterday, you're now up 2%. So like, how much more do we bounce from here? It's hard to say. But I think you've already gotten a good chunk of the bounce in the last 2 days or so. You're only now down 4.75% from all-time highs. So first and foremost, before we get into the news headlines today, why stocks may have, bounced, you got to take a look at this ADP employment change. It came in at 77,000, about half of the estimated 140,000. Private sector jobs really disappointed today. Okay, there were some stronger areas like leisure and hospitality that added 41,000 jobs. Professional business added 27,000. You did see a contraction in resource and mining, but not too much of a contraction, but you really just didn't see areas add many jobs. And a lot of this does have to do with the economic uncertainty with Washington. The head of the ADP, this is again the private payroll report, not the one from the government, but the private one, says, quote, policy uncertainty and a slowdown in consumer spending might have led to layoffs or a slowdown in hiring. Our data combined with other recent indicators suggest a hiring hesitancy among employers as they assess the economic climate ahead. Basically saying the volatility out of Washington is, putting companies in a bad position. Like, do you really want to go out on a limb and start hiring a bunch of people when everything you thought was going to happen could change within minutes? I mean, with the news flow we're getting, like that's a logical way to think. So the last thing companies want to do right now is go overhire. And that is an issue for the economy. Keep in mind, we are going to get our jobs report coming out on Friday, And that is going to be the big catalyst that'll tell us a lot more about the state of the labor market. You're still expecting 160,000 job ads following today's data. Last month was 143,000. I think this number's far too high, and you could see a similar like 50 to 70,000 job ads for the non-farm payrolls number. Now, when you factor in government workers, that we are expecting a decline of about 20,000, I think that could come in closer to about 50,000. You could be looking at an even worse number that I just put out. The unemployment rate will also be important, expecting that to hold steady at 4%, but any move higher there is going to get Wall Street a little nervous, especially with the impetus of what could be another wave of inflation that could be coming due to tariffs. Now, I don't buy the whole tariffs are going to cause inflation thing. I think consumers are just not going to pay the higher prices. Now, what does that mean? Consumers are going to stop buying as many of those products. Companies are going to idle their factories, and they're going to have to cut prices to keep their factories at mass production, at full production. The worst thing you can have happen is raise your prices, people stop buying as many products, you have to idle your factory. That really hurts your margins, like an auto company. The last thing you want to do is slow down production. You would rather cut prices before you slow down production and not utilize your factory at its max capacity. Now, also in the news today, White House Press Secretary Leavitt says U.S. and Ukraine talks are happening as we speak. She says that Trump is committed to the peace deal and that they may resume funding for Ukraine in the meantime. White House Press Secretary says the Trump administration is doing everything they can on inflation, which is actually kind of interesting because just about an hour ago, U.S. Commerce Secretary Lutnick says there is going to be a short period of time where there are high prices on certain items following tariffs. I mean, it's kind of back and forth, right? What is it? Is this going to help inflation? Is it going to hurt inflation? I don't think it can help inflation, but it can weaken the economy, which in and of itself is deflationary, or at least disinflationary. It was also reported that Trump and Trudeau held a call today that was about 50 minutes long, and the call with Trudeau ended in a, quote, somewhat friendly manner. The markets have really been reacting to some rumors today that there may be a concession to the tariffs, that there could be some deal being reworked right now that would potentially meet Trump in the middle on 25%, like 15% potentially, with Canada doing some other concessions. Now, what I actually think is going to happen is there is going to be a concession to meet in the middle around 15% on tariffs, but I do think there's probably going to be some kind of larger commitment to buy 10-year treasury yields, longer dated treasuries, to bring down interest rates. I think that's kind of what the signs are pointing to, but we'll have to wait and see. U.S. Commerce Secretary Lutnick does again confirm the April 2nd tariff agenda is still coming. Those are those reciprocal tariffs. And apparently the U.S. Sovereign Wealth Fund will be financed by tariffs, according to sources, which actually did give the markets a little bit of a rally when this news came out, because, I mean, it would be the government buying essentially stocks. So who doesn't love that if you're a greedy capitalist like we all are? And again, Trump's trade advisor Navarro says Trump was right. There will be some tariff disturbance. He also did acknowledge that we've had 2 days of volatility in markets, and last I checked, to be fair, I think it's been more than 2 days. And Navarro says that Trudeau should, quote, tone it down. This morning, we did get EIA crude oil inventories that came in at 3.614 million. The forecast was 0.8 million. What's interesting about that, given the data that we had out today with the ADP employment change that massively missed estimates, is you have more inventory of oil, which is, helping to bring down prices essentially. You have a weaker economy, and you have the OPEC plus output increase that is causing oil to fall 3% today. And I think this is a story of the inflation dynamic that not a lot of people are going to talk about. But as oil falls, it is going to, help bring down inflation for really everything, okay? And could offset some of the tariffs that, could continue, okay? No matter what it is, okay? No matter if it's this Lipton green tea or it is this Roku remote or it is this cup that I had coffee in. I didn't produce any of that. It was produced somewhere, shipped somewhere else, shipped to a store, and I drove and bought it, okay? So even if it's not necessarily something that is made with oil, oil touches everything that we use, that we do not personally produce. And I think that's important to remember, and that's why oil has such a deep impact on inflation, from really the roots of the product. And Canada said this morning before the call with Trudeau and Trump that Canada won't end tariffs unless all US tariffs are lifted. And another headline that the markets really liked was the White House press secretary, Leavitt, that says Trump is open to hearing about additional tariff exemptions. The Fed Beige Book did come out as well today. I will read you the overall economic activity. This is something Fed Jerome Powell himself has said, if you ever think the economic data is a bit, back and forth, just read the Fed Beige Book and that'll tell you kind of what the Fed is looking at and how they're looking at the economy. So it says here, overall economic activity rose slightly since mid-January. 6 districts reported no change, 4 reported modest growth, and 2 noted slight contractions. Consumer spending was lower on balance, with reports of solid demand for essential goods mixed with increased price sensitivity for discretionary items, particularly among lower income shoppers. Unusual weather conditions in some regions over recent weeks weakened demand for leisure and hospitality services. Vehicle sales were modestly lower on balance. Manufacturing activity exhibited slight to modest increases across a majority of districts. Contacts in manufacturing range from petrochemical products to office equipment. Expressed concerns over the potential impact of looming trade policy changes. Banking activity was slightly higher on balance among districts that reported on it. Residential real estate markets were mixed, and reports pointed to ongoing inventory constraints. Construction activity declined modestly for both residential and non-residential units. Some contacts in the sector also expressed nervousness around the impacts of potential tariffs on the price of lumber and other materials. Agricultural conditions deteriorated some among reporting districts. Overall, expectations for economic activity over the coming months were slightly optimistic. So actually not a bad Fed Beige Book at all compared to what we have gotten recently. On prices, the Fed Beige Book says, prices increased moderately in most districts, but several districts reported an uptick in the pace of increases relative to the previous reporting period. Contacts in most districts expected potential tariffs on inputs would lead them to raise prices, with isolated reports of firms raising prices preemptively. As far as labor markets, employment nudged slightly higher on balance, with 4 districts reporting a slight increase, 7 reporting no change, and 1 reporting a slight decline. Multiple districts cited job growth in healthcare and finance, while employment declines were reported in manufacturing and information technology. Labor availability improved for many sectors and districts, though there were occasional reports of a tight labor market in targeted sectors or occupations. Contacts in multiple districts said rising uncertainty over immigration and other matters was influencing current and future labor demand. Wages grew at a modest to moderate pace, which was slightly slower than the previous report, with several districts noting that wage pressures were easing. So overall, that's pretty good, showing some weakness, but not terrible. This morning, we did get the ISM services PMIs as well. On the headline number, it came in pretty good at 53.5 versus estimates of 52.6, and last month was 52.8. And this is something that I was talking about yesterday. You really can't have too much weakness at all in services, considering manufacturing is so weak. Manufacturing is about 20% of the economy, services 70, 80-ish percent of the economy. Any weakness in services really brings up that recession fear. So you didn't exactly get that today. So that's good overall for the growth concern, and that's a positive development, I would say, for the markets. Now, factory orders month over month also came in strong at 1.7% versus the estimate of positive 1.6%. Business activity came in at 54.4 versus estimates of 54.2, so that beat. Employment came in at 53.9, beating estimates of 52.1. New orders came in at 52.2 versus estimates of 51.2, and prices paid came in at 62.6 versus estimates of 60.0. So prices came in a little bit hot, but all other metrics came in good. Now, what I will tell you about this is essentially a survey. Okay, it's not hard data. So keep that in mind, that it's not the biggest thing markets are going to react to. The bigger things that markets will react to will be the Friday jobs report. And I think that's really what we want to be looking out for, because that's the next big catalyst to tell us, hey, are we going into a, slower growth environment? Are we going to start seeing some growth concerns? Or was it overblown to begin with? Tomorrow, we will get more important economic data as well. Challenger job cuts, expecting that to rise to 56,000. That is essentially planned layoffs, so keep that in mind. We will get a balance of trade report, exports, and imports. This will give us a new GDP update from the Atlanta Fed. It's currently at negative 2.8%, which scared a lot of people. But with tomorrow's data, you could see this bounce up quite a bit, as long as those export numbers do not come in substantially weaker than the import numbers. Okay, that's what goes into your GDP report. You will also get initial jobless claims tomorrow morning, expecting 235,000. Again, if that comes in too high, growth concerns are back. Keep that in mind. You will also get wholesale inventories month over month, which will feed into that new GDP update from the Atlanta Fed. You will get a speech from Fed Waller as well at 3:30 p.m. And this leads us into the Friday jobs report with the non-farm payrolls, the unemployment rate, and Fed Bowman, Fed Williams, Fed Kugler, and Fed Jerome Powell that will be speaking Friday afternoon. Now, Jim Cramer says he does not see a trade deal on the horizon and that optimism might be misplaced. So if the inverse Cramer effect holds true, that means here soon, we're going to get a deal. But something I do want to point out to you guys, Liz Young Thomas on X says the average of the ISM manufacturing and services prices paid component rose to 62.4 in February, the highest since June of 2022 when inflation peaked. There could be real pressure building, and if it doesn't cool off soon, we could actually see inflation turn higher. You can see this dotted purple line here tends to spike before inflation. Now, again, this is a survey. The ISM is a survey of expectations of inflation, essentially, in the manufacturing and services sector. I think the tariff dilemma is really why these expectations are moving higher. And I mean, Trump, the White House, they're literally telling you to expect some kind of inflation, at least short term, from tariffs. We're probably going to get that. And that's the issue here. If the economy continues to weaken, the Fed's not really going to be able to go out and ease policy too much. So we're going to be in a very tricky situation here soon, balancing inflation and trying to balance the economy. Mnuchin, which was the Trump 1.0 Treasury Secretary, says it's pretty clear the Fed is going to lower rates. So, of course, we're expecting the Fed will lower rates this year. Question really is when and why. If the Fed is forced to cut rates because the economy sucks, that's not exactly great for stocks. But if we don't get the inflation that now some people are forecasting, that's going to be really good for markets if the Fed is able to cut because of that. Here on the day today, let me give this a little bit of an update. CNN's Fear and Greed Index is coming in at 21, really staying stable down here in extreme fear. Yesterday, you were at 19, so you're really not moving too much, and there's still a considerable amount of fear out there. The market momentum component, extreme fear. Stock price strength, extreme fear. Stock price breadth, extreme fear. Put and call options, extreme fear. Market volatility, extreme fear. Safe haven demand, in extreme fear. The only thing not in extreme fear is junk bond demand, and that is in extreme greed, which is fascinating. The percent of stocks trading above their 50-day moving average today is recovering a bit to 30.6%, up 1.5% today. Overall, this is good, but you're still, again, in a very weak place and nothing has really changed. And coming tomorrow, we will be getting a new AI investor sentiment survey. And last week, this came in at the most bearish you have seen since the lows of 2022. Really, investors last week were as bearish as, normally when the S&P is down over 25%. Like, you are at levels of fear you don't ever see unless you are deep in a bear market. So we've only fallen since then on markets. Does sentiment improve or does sentiment come in even worse? I think that's going to be another very fascinating sentiment data point that we will get tomorrow. Now, here on the day today, the big loser is really TLT and long duration bonds. Some of the inflation concerns definitely working their way into the bond market. Whereas, again, there was bad data as well today with the ADP employment change, but bond investors are focusing more on the inflation comments that we got today out the White House and now the Fed beige book. And, well, they don't like any of it. So the odds of Fed cuts are moving lower today. Yesterday, there was about a 41% chance of a Fed rate cut May 7th. Now that is sitting at 37.3%. So you did fall about 4 or 5%-ish in Fed pricing for a May 7th cut. The Wall Street is currently expecting the first cut from the Fed coming June 18, 2025, with a 52.6% probability. What is interesting, though, is you're pricing in a greater probability of 2 rate cuts by June than no rate cuts at all by June. So 2 rate cuts by June is priced at 25.2%. 3 rate cuts is priced at 1.4%. That would be kind of wild. And no cuts by June is only priced at about 20.8%. So you are leaning more towards multiple cuts by June versus a continued pause. So let me know what you guys think about this information down below in the comment section. Again, as I said earlier, I think you could get up to this 100-day moving average. It's hard to forecast new all-time highs when you have this much uncertainty. I think that is a big barrier until we get some clarity on inflation from the Fed later this month and ultimately, where the economy's going. And I think it's going to be a lot of chop. We could bounce here, fall to new lows, bounce again, fall to new lows, and kind of make our way lower until the uncertainties kind of dissipate a little bit. So let me know what you guys think about this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.